Welcome to part 1 of the Week 4 live chat here in Finance 4602, International Finance. In this session, we're diving into some important concepts around financing international trade, short-term financing, and international cash management. The goal is to make these concepts practical so you can see how they connect to the real world of global business. This week's readings cover 3 chapters. Chapter 19 focuses on financing international trade, things like letters of credit, drafts, consignment, and open account methods. Chapter 20 shifts into short-term financing with a spotlight on currency depreciation and foreign currency portfolios. Finally, Chapter 21 takes us into international cash management, where we will talk about optimizing cash flow across multinational subsidiaries. Let's begin with a big picture comparison of payment methods. Exhibit 19.1 highlights how exporters and importers decide who takes on the risk. Prepayment means the buyer pays up front, giving the exporter maximum protection, but leaving the importer to carry the risk. At the other extreme, open account terms give the importer the advantage, while the exporter is trusting the buyer to pay later. Everything else falls somewhere in between. Prepayment is essentially cash in advance, usually made by wire transfer. Exporters like it because it removes all payment risk. Importers often dislike it, but they may agree if they are a first-time buyer, if the exporter fears pre-shipment cancellation, or if the buyer is located in a politically risky country. Next, we look at letters of credit. These provide a balance between exporter and importer protection. The importer's bank issues a commitment to pay once it receives shipping documents proving the goods were sent. This system helps build trust in new business relationships and reduces the exporter's risk compared to an open account or consignment arrangement. Drafts, also called bills of exchange, are formal demands for payment. The exporter issues a draft requesting the importer to pay on site or at a specified future date. Drafts offer less protection than letters of credit because banks are not obligated to guarantee the payment, but they are still a common tool in trade. Another method is consignment. The exporter ships goods but retains ownership until the importer actually sells them. The importer only pays once the goods are sold to a third party. This can be risky for the exporter since the goods are already overseas and payment depends entirely on the importer's honesty and success in selling. Open account is essentially the opposite of prepayment. The exporter ships the merchandise first and expects the buyer to pay later. This method requires a high level of trust and is most often used when two companies have a strong, ongoing relationship. Trade finance methods include accounts receivable financing, factoring, bankers' acceptances, and forfeiting for medium-term capital goods. These tools provide liquidity to exporters and help bridge the gap between shipping goods and receiving payment. For example, accounts receivable financing allows banks to lend against receivables, while factoring means selling those receivables outright, often without recourse. That means the risk of collection shifts away from the exporter. Now let's take a look at the role of government agencies. The Export-Import Bank of the United States was established back in 1934. Its job is to support U.S. exporters by providing guarantees, loans, and insurance programs that make American companies more competitive abroad. Other organizations include the Private Export Funding Corporation, or PEFCO, which provides medium and long-term financing, and OPIC, the Overseas Private Investment Corporation, which protects U.S. investments against political risks like expropriation or currency inconvertibility. When companies look for funding, they start with internal, short-term financing. That means checking whether other subsidiaries within the company have excess cash that could be shared internally. Multinational corporations must have systems to monitor these flows carefully. If internal funds are not enough, companies may turn to external short-term financing. This could include issuing short-term notes, commercial paper, or obtaining loans direct from banks. One lesson from the credit crisis of 2008 is that access to this type of funding can dry up rather quickly. Sometimes multinational corporations borrow directly in foreign currencies. For example, if a company expects future cash flows in euros, it might borrow in euros today. This way, loan repayment is naturally hedged against incoming revenues. However, this strategy is not without some level of risk. If the borrowed currency appreciates significantly, the company ends up owing more in its home currency. To protect against this, firms often hedge by buying the foreign currency forward for the repayment date. Now let's turn our attention to working capital management. Subsidiaries face more uncertainty when their purchases are international because of fluctuating exchange rates. Similarly, their sales and accounts receivable can be more volatile than if they operated domestically. Subsidiaries also manage dividends and liquidity. Predictable dividend payments make forecasting easier, while liquidity management ensures subsidiaries invest excess cash or borrow to cover shortfalls. For this reason, many firms choose to centralize their cash management. By pooling resources at the corporate level, multinational corporations can reduce the total amount of idle cash sitting across all subsidiaries. Centralized management makes the whole system more efficient. This wraps up part 1 of our Week 4 live chat. As always, if you have any questions, reach out and let me know. In the meantime, I'll see you online.